Hi looters, welcome back to Tick to Loot market updates for July 26th, 2026. Before we dive in, a quick reminder. This video is for educational purposes only and is not financial advice. Markets carry risk, so always do your own research and consult a licensed financial advisor before making any trading decisions. Today we'll recap yesterday's moves, walk through today's calendar, and unpack the headlines shaping risk sentiment across the globe. Let's get into it. Let's start with what happened yesterday. The U.S. equity landscape was a mixed bag. The Dow Jones nudged higher, the S&P 500 held steady, while the Nasdaq slipped lower. That divergence signals a tug-of-war between growth-oriented tech stocks and more defensive industrials. Traders tend to watch these moves because they often set the tone for risk appetite in the currency markets. A stronger Dow can lift the dollar, whereas a weaker Nasdaq may push investors towards safe haven assets like the yen or Swiss franc. The lack of any major economic releases kept the focus on price action alone. Moving to today's calendar, the only scheduled data point is Japan's SBPI year-over-year reading. The forecast sits at 3.4%. Just a hair above the previous 3.3% figure. SBPI, or the Services Producer Price Index, tracks price changes that producers of services pass on to their customers. Even though the impact rating is low, any surprise, especially a higher-than-expected number, could nudge the yen lower as traders anticipate tighter monetary policy from the Bank of Japan. Conversely, a softer print would reinforce the yen's safe haven appeal amid ongoing geopolitical jitters. Geopolitics remain front and center for traders. Recent reports highlight that tensions in the Middle East are still elevated as the weekend approaches. Heightened risk in that region typically fuels demand for safe haven currencies such as the Japanese yen, Swiss franc, and US dollar, while putting pressure on commodity-linked pairs like the Australian and New Zealand dollars. The market's risk-off bias can also spill over into equity volatility, reinforcing the mixed equity moves we saw yesterday. Keep an eye on any sudden escalation. It could quickly shift sentiment and affect currency spreads. The mixed U.S. index performance ties back to divergent sector dynamics. The Dow's modest rise reflects strength in traditional industrials and energy, while the Nasdaq's dip points to a pullback in high-growth tech stocks, possibly due to lingering concerns over future rate hikes. The S&P's flat close suggests that the broader market is waiting for clearer direction from upcoming data releases. For Forex traders, this split can translate into a dollar that is modestly firm against riskier currencies, but still sensitive to any surprise in upcoming U.S. economic numbers. Turning to the United Kingdom, the Flash Services PMI came in at 51.8, well above the 49.4 forecast and up from 48.8 in the prior month. A reading above 50 signals expansion, and this stronger-than-expected services activity suggests the UK economy is gaining momentum despite broader global uncertainty. Analysts see this as a potential catalyst for the pound, especially if it hints at a more accommodative stance from the Bank of England on future rate moves. However, the impact remains moderate because the data is still a flash estimate and subject to revision. Across the euro area, business activity finally broke a 4-month slump. The Flash Services PMI rose to 51.6 versus a 49.8 expectation, while manufacturing edged up to 52.0. beating the 51.5 forecast. The composite PMI settled at 51.9, comfortably above the 50.3 consensus. These numbers suggest demand conditions are improving, giving the euro a supportive backdrop. Market participants often link stronger PMI readings to a higher probability of a tighter monetary stance from the European Central Bank, which could lend the euro some upward pressure against the dollar and yen in the days ahead. Germany's flash manufacturing PMI came in at 52.2, outpacing the 50.5 forecast and rising from 50.3 in the previous period. The robust German manufacturing data reinforces the broader Eurozone uptick and adds weight to the narrative of a revitalizing European industrial base. For Forex traders, a healthier German economy can boost confidence in the euro, especially if it translates into stronger export demand. Yet, it's worth remembering that the services sector in Germany still sits just below 50 at 49.6, indicating mixed signals within the domestic economy. In commodity news, oil prices have taken a breather, pulling back from recent highs as the week winds down. Lower crude prices tend to ease pressure on commodity-linked currencies, such as the Canadian and Australian dollars, which have been riding the oil rally. With the market entering the final stretch of the week, traders are adopting a more cautious stance, allowing risk-off currencies to regain some ground. The dip also reflects easing concerns over supply disruptions, though any fresh geopolitical flare-up could reignite price momentum quickly. A lingering question this week is how interest rate expectations have adjusted after a flurry of data releases. The mixed U.S. equity performance, stronger UK and Eurozone PMI figures, and softer oil prices have all fed into the market's recalibration of future rate moves. Analysts are watching the yield curve for signs of flattening or steepening, which can signal shifts in central bank policy outlooks. Those shifts, in turn, ripple through the Forex market, influencing everything from the dollar's carry trade appeal to the yen's safe haven status. That wraps up today's market snapshot, looters. We've covered yesterday's mixed equity moves, today's low-impact JPY SBPI data, the fresh UK and Eurozone PMI numbers, easing oil prices, and the evolving rate expectation landscape. Remember, this analysis is for educational purposes only and not a recommendation to trade. If you found this update useful, hit the subscribe button for tomorrow's briefing and keep sharpening your market instincts. Until next time, stay curious and stay savvy.